1994. A financial planner named William Bengen publishes a 27-page paper in a journal most people have never heard of, the Journal of Financial Planning. One simple formula: withdraw 4% of your retirement portfolio in year 1, adjust for inflation each year after, and your money will last 30 years. That formula became scripture. Wharton teaches it. Fidelity builds it into their calculators. Vanguard bases their retirement tools on it. Your financial advisor, the one charging you 1% annually, is probably using it right now to map out your golden years. But here's what nobody's saying out loud. If you're over 50 today, that 1994 document might be the single biggest threat to your retirement. Not market crashes, not inflation. This, a 30-year-old formula that everyone still treats like gospel. Why does a rule trusted by every major bank in America suddenly become dangerous? And why is the industry so quiet about it? Look, I'm not here to manage your portfolio or sell you anything. I'm just reading the numbers. And the numbers tell a very different story. Bengen tested his 4% rule on market history from 1926 to 1992. 66 years of stock and bond returns. Decades of recessions, wars, bull markets, crashes, the whole spectrum. The problem? That dataset doesn't include the world you're retiring into. August 15, 1971. A Sunday evening, President Nixon goes on national television and announces that the United States dollar is no longer convertible to gold. The gold standard, dead. From that moment forward, the Federal Reserve gained a power it never had before, the ability to print money with no physical limit. The fiat era, 1971 to today, 55 years of a completely different economy. Inflation during that period? 700%. The dollar in your wallet right now is worth 12.5 cents, compared to $1 in 1971. Bengen's data was built on an economy where the dollar was tied to gold. You're retiring in a world where the government can print trillions in a single year, and did, in 2020 and 2021. Inflation. Everyone knows about inflation. But here's what nobody tells you. Even if your portfolio is growing, even if your stocks are up, you're still walking into a mathematical trap. Not about prices at the grocery store. It's about something far more dangerous, the order in which market crashes happen. Year 2000. You've just retired with a portfolio of $1 million. You follow the 4% rule. Withdraw $40,000 in year 1. Adjust for inflation every year after. Simple. Safe. Then the dot-com crash hits. 2000 to 2002. The market drops 49%. Your $1 million portfolio? Now $510,000. But you're still withdrawing that $40,000 every year, plus a little more for inflation. Now you're sitting at $470,000. The market eventually recovers. Let's say it goes up 30%. Except now you're only back to $611,000. Not $1 million. In this scenario, you'd have permanently lost $390,000. Why? Because you can't recover what you already spent. This is sequence of returns risk. Not just about whether the market crashes. It's about when. The order matters more than the crash itself. If you'd retired in 1999 instead of 2000, just 1 year earlier, the difference by 2010 would have been $300,000. 1 year. Here's the kicker. Bengen tested his rule on data from 1926 to 1992. He couldn't have known what was coming. From 2000 to today, we've had 3 massive crashes in a row: dot-com bust, housing crisis, pandemic. His data ended 8 years before the first one hit. Private savings depend heavily on timing. But surely the government protects retirees through Social Security, right? June 2025. The Social Security Administration releases its annual Trustees Report. Hundreds of pages of actuarial tables and projections. Buried in there is one number that should concern anyone planning to retire in the next decade: 2034. That's the year the trust fund is projected to run out, according to the Social Security Administration's official forecast. After that, Social Security would only be able to pay 81% of promised benefits from current payroll taxes coming in. No reserves. No safety net. If you're 50 years old right now, by the time you're 58, your Social Security check could be automatically cut by 19%. Not because of a political decision, not because of some future crisis, because the actuarial math projects it. This isn't some doomsday prediction from a cable news pundit. This is actuarial science. The same people who calculate insurance premiums for Boeing and NASA. They're not guessing. They're counting. But here's the real concern. Even that 81% they'd be able to pay, it might not cover your actual inflation. Why? Because the way Social Security adjusts for inflation, there's a structural mismatch in the calculation. Every year, Social Security gets adjusted for inflation through COLA, cost of living adjustment. The government tracks inflation and bumps your check accordingly. The problem: COLA is based on the Consumer Price Index, the CPI, a basket of goods that reflects what the average American buys. Food, housing, transportation, healthcare, all weighted by how much the typical household spends. But in that basket, medical care is only 8.5% of the total weight. The average American over 65? They spend 15 to 20% of their budget on healthcare, prescriptions, doctor visits, Medicare premiums, long-term care, not 8.5%. Double that. So the government is giving you an inflation adjustment, but it's understating your actual inflation by 6 to 12% every single year. Over 20 years of retirement, that gap could cost you between $150,000 and $200,000. Not speculation, just compounding the difference. This isn't a bug. It's a feature. Understating inflation for retirees saves the federal budget trillions over decades. Take stock. Your private savings depend on luck and timing. The government projects benefit cuts in 2034. And the inflation adjustments they do pay? Calculated on a formula that may fall short of your real expenses. What's left? Here's the question nobody asks out loud. Why hasn't the financial industry updated the 4% rule? Because updating it would mean admitting something difficult, that many current retirement plans may be underfunded by 30 to 40%. If Fidelity tells its clients tomorrow, actually, you don't need $1 million for retirement, you need $1.4 million, what happens next? Panic. People start pulling money out. Stocks drop. The system could face significant disruption, so the industry keeps selling the mirage. Because the alternative is chaos. But here's the irony. William Bengen himself, the guy who created the 4% rule back in 1994, he updated it in 2025. He ran the numbers again, this time including data through 2020. All three crashes. .com. Housing. Pandemic. His new number? 4.7%. His safe max, the worst-case withdrawal rate that survives the modern era, according to his updated analysis. Your financial advisor? Still using 4%, because changing the protocol means rewriting hundreds of thousands of contracts. Lawsuits. Admissions of failure. They know, they just don't tell you. So if the system has structural issues, what can you consider doing about it? This has happened before. The 1970s. Stagflation, high inflation, and a stagnant economy hitting at the same time. 1974. Inflation hits 11%. The stock market crashes 48%. Unemployment climbs to 9%. Retirees who left the workforce between 1968 and 1973, they lost 40 to 60% of their purchasing power over the next decade. Not because they made bad decisions, because the economy ate them alive. Why does this matter now? Because we're seeing similar patterns. Inflation in 2021 through 2023 peaked at 9.1%, the highest since 1981. The Federal Reserve raised interest rates from 0 to 5.5% in 18 months, the most aggressive hiking cycle since the early 80s. In 2022, the bond market lost 30%, the worst year for bonds since 1788. Retirees in the 70s didn't know what was happening to them until it was too late. We do, but are we acting on it? History doesn't repeat, but it rhymes. The difference. Back in the 70s, U.S. national debt was $370 billion. Today, $35 trillion. The Federal Reserve has far less room to maneuver, far fewer tools to save the system. If history follows the same pattern, what might we expect? Past patterns don't guarantee future outcomes, but they do offer warnings worth considering. Here's something worth considering. Not as financial advice, but as a data exercise. You might open the BLS CPI calculator. That's the Bureau of Labor Statistics, the official government site. You could type in the year you were born. See how much the dollar has lost over your lifetime. Some people take their retirement plan and look at what they're budgeting for annual expenses, then multiply it by 1.5. That's an estimate of the real inflation you might experience by 70, once you factor in healthcare and housing costs that historically outpace the official numbers. If your current savings don't cover that adjusted number, you've got time to reassess your approach. Look, I can't give you financial advice. I'm not managing your money, and I'm not a licensed financial advisor. But the calculator doesn't lie. The math is right there. This is historical data analysis, not a recommendation. This isn't about fear. It's about arithmetic. Here's the trap most people fall into. They'll open that calculator, see the numbers, feel the shock, and do nothing. Why? Because changing your savings plan at 50 means admitting something painful, that for the last 20 years, you believed in the wrong formula. The real question isn't, how do I make more money? The real question is, why am I still using 1994 math in a 2026 world? William Bengen created the 4% rule based on the best data he had. He couldn't predict the dot-com crash. He couldn't predict 2008. He couldn't predict 2020. But you can look at what happened, because you have data he didn't have. You have the history of 3 crashes. You have the fiat currency era. You have the CPI calculation mismatch. You have the 2034 projection staring you in the face. Bengen updated his rule in 2025. Your bank didn't. Who do you trust more? The guy who created the formula, or the people making money off it? The 1994 paper isn't what destroys retirements. What destroys them is blind faith that old rules still work in a new world. If this video made you think, share it with someone over 50. Not as a scare tactic, as a reality check. Subscribe if you want more of these breakdowns. I'm not promising to make you rich. I'm promising to show you the numbers other people prefer to hide. William Bengen updated his rule to 4.7% in 2025. Your financial advisor didn't. Ask why.